Most people researching reverse mortgages in 2026 are getting the same recycled list of pros and cons from 2015. Listen, the rules have changed, the market has changed, and some of what you read online is flat out wrong. I'm going to give you the real version today, including the stuff most people never tell you. The problem is, most of the information out there is either designed to scare you away from it or designed to sell you on it fast. Neither of those are helpful. What you actually need is a straight look at both sides with no agenda so you can make a decision that is right for your situation. Let me start with what actually makes a reverse mortgage powerful for the right person. When you tap your equity through a reverse mortgage, that money comes to you tax free. It is not income, it is a loan advance. So it does not show up in your tax return and it does not affect your Social Security or Medicare eligibility. And here's the part people genuinely underestimate: you do not ever make a monthly mortgage payment as long as you live in the home. For someone sitting on $1 million or more in home equity and a fixed retirement income, that combination, tax-free cash and no required monthly payment, can completely change how your retirement feels financially. Here is the one that surprises almost everyone I talk to. If you take out a reverse mortgage as a line of credit instead of a lump sum, that unused line of credit actually grows over time. It grows at the same rate as your loan interest rate, plus 1/2%. So the longer you leave it untouched, the more available line of credit you have. Think about that. You could set this up at 62, not touch it for 10 years, and have significantly more access to funds at age 72 than you did when you started. This is not a marketing line. It is how the product is structured by HUD, and it is one of the most underused retirement planning tools I have ever seen. Okay, now let me give you the honest downside, and I'm not going to sugarcoat this because you're not making monthly payments. The interest on your loan is actually being added to the balance every single month. That balance grows over time and it compounds. If you take a large lump sum up front and live in the home for 20 years, your loan balance could be substantially larger than what you originally borrowed. For some people, that doesn't matter at all because, they're not focused on leaving the home to their heirs. But for others, especially those with a strong goal of passing the home down, this is the real cost you need to understand before you sign anything. This is the one that catches people off guard. And I want to make sure that you hear it clearly. A reverse mortgage becomes due and payable when certain things happen, what the industry calls trigger events. Those include moving out of the home as your primary residence, selling the home, failing to pay your property taxes, failing to keep homeowners insurance, or letting the property really fall into significant disrepair. If any of those things happen, the loan comes due. For most healthy, financially stable homeowners, these are manageable responsibilities. But if your health changes or your financial situation shifts, these requirements can create real pressure. Know them going in. So what is actually different in 2026 compared to a few years ago? A few things are worth knowing. Lending limits have increased, which means if you have a high value home, you can access more equity than was possible before. Interest rates have actually settled into a range that makes the line of credit strategy even more attractive for long-term planning. And there has been a meaningful shift in how financial planners are treating reverse mortgages. More fee-only advisors are recommending them as a coordinated piece of retirement income planning rather than a last resort. The product has not changed dramatically, but the context around it has, and that changes the conversation. I hear this one constantly. My kids want the house and I don't want to take that away from them. I get it. Listen, that is a real concern and it deserves a real answer. Here's the truth. Your heirs can absolutely keep the home. They just need to pay off the loan balance when you pass, either by refinancing it, selling the home, or paying cash. And if the home sells for more than the loan balance, your heirs keep the difference. They get the equity. If the home ever sells for less than the balance, the FHA insurance covers the gap. Your family ends up owing nothing beyond the home itself. Look, the goal of this video was not to tell you that a reverse mortgage is right for you or wrong for you. The goal was to give you a real picture so you can actually make the call yourself. If you want to see what the numbers look like specifically for your home and your situation, that is exactly what I help people with. Run your numbers for free. Just head on over to perpetualretirement.com. The link is in the description down below. And I'll see you on the next one. Run all your numbers, see if it fits for you, and then we can chat.